In this video, we're going to walk through Nike's most recent annual cash flow statement. This is the final part of a three-part series which we walk through the income statement, the balance sheet, and this one, the cash flow statement. If you'd like, you can always go back and watch those other two videos. Okay, on to the cash flow statement. The cash flow statement is a very important statement because it shows the actual cash being paid by the company and to the company for a given period of time. For this review, we're going to use Nike's most recent annual filings. You can see here that their fiscal year ended on May 31st, 2017. Also note that these numbers are all in thousands. Okay, so the first thing to note about a cash flow statement is that they're broken into three different sections: operating cash flow, investing cash flow, and financing cash flow. Each are important in their own right, and each serve a different purpose. Cash flow from operations is how much cash the company generates from operating their business. You can see here that you get cash flow from operations by making adjustments to net income. All of these numbers, which we'll review in a minute, are those adjustments. The next section is cash flow from investing. Cash flow from investing looks at the cash that the company spent on property, plant, and equipment, sometimes called PP&E, or investing in other companies or bonds, things like that. The final section is cash flow from financing. Cash flow from financing is when, in this case, Nike were to issue bonds or pay back bonds or pay dividends or do stock buybacks, things like that. That all ends up in the financing section. Okay, let's start with cash flow from operations. So we start with the $4.24 billion net income number, and we start making adjustments to it. Now this net income number is the exact same number on Nike's income statement. You can see that here. Okay, this first adjustment is depreciation. A quick primer on depreciation, just in case. Let's imagine that Nike were to go out and buy clothing machines, and they were to spend $1 million on those machines. And let's pretend that those machines are going to last 10 years. So they spent $1 million in cash, it's going to last 10 years. In theory, every year that passes, the value of those machines drops by, let's say, $100,000. The initial $1 million investment would fall under capital expenditures in the cash flow from investing section. So on the income statement, they only account for $100,000 each year. But on the cash flow statement, they only account for what cash is being laid out. So if this were halfway through, if it was 5 years ago that they bought those machines, well, the income statement would reflect a $100,000 expense, a depreciation expense. Since that's not really cash being laid out this year, you have to add that back to net income to account for it in cash flow from operations. The same concept holds true for the rest of these numbers. Adjustments to net income are things like stock-based compensation or deferred income taxes or amortization, which is similar to depreciation but for intangible assets. In each of these examples, cash is not actually being laid out. They're just adjustments that need to be made to net income. Okay, changes in accounts receivables. Accounts receivables is money that is owed to Nike from their customers. The fact that this is a negative number means that Nike sold more on credit than they collected in cash. Changes in liabilities. Okay, same concept here. Liabilities are what the company owes to, let's say, suppliers. Well, if they paid $364 more than the previous period to those suppliers, then cash needs to be deducted from net income to account for this period's cash flow. Moving right along, it looks like they increased their inventory by $231 million from the previous period. We know that they increased it because it's a negative number, which means they paid out more cash. Okay. Other cash flow. This could be a lot of different things, so I pulled down Nike's actual cash flow statement, and I saw that for them, this is an increase in prepaid expenses. An example of a prepaid expense would be something like if Nike prepaid insurance for the full year or for the next 6 months. Well, they laid out the cash, hence the reason it's affecting the cash flow statement, but it doesn't land on the income statement until that time passes and it is therefore expensed. So total cash from operations is $3.64 billion, and we'll come back to this one in a minute. Okay, the next section here is cash flow from investing. Now, we're no longer tied to net income. You can see that this section is sort of a standalone section. And the best part is it's fairly self-explanatory. Capital expenditures. This is directly related to the depreciation line we mentioned up in the cash flow from operations. Capital expenditures is defined as what a company spends on assets that it needs to run a business. This could include things like building, equipment, furniture, computers, vehicles, and things like that. And those are all related to depreciation because each of those assets need to be depreciated over time. So you can see here they spent $1.1 billion on assets needed to run the business. But what happens if they bought something that they don't need to run the business? Well, you can see that number goes here under investments. And since this is a positive number, it looks like they sold an investment. Otherwise, it would be an outflow of cash and the number would be negative. This could be a lot of different things. And for Nike, it looks like this was tied to hedges when I looked it up in their annual report. And that's a form of investment, so that it's proper to land that here. It's also only $21 million, so I'm not terribly concerned relative to how large their $1 billion investing cash flow number is. The financing cash flow section is much like the investing cash flow section in that it can really be examined standalone. This is not tied to net income like operations was. Dividends paid. Okay, well, this is an easy one. It looks like Nike paid $1.133 billion in dividends. Okay, this next one, sale or purchase of a stock. Well, it looks like they bought back $2.7 billion in stock. We know that it was a buyback because this was a negative number. If it was a positive number, it would mean that they issued shares and they received cash for it. Okay, on to net borrowings. So this is a positive number. This means that what most likely happened is that Nike issued bonds. We know that because it's an inflow of cash, hence the number being positive. Now we say net because it's also likely that they made some payments on other bonds that they had outstanding. So if they paid back $100 million and they borrowed $1 billion, this would be a positive number of $900 million. Okay, here's that other category again. Nothing there, so once again, that could be a lot of different things, but since there's nothing, we'll just skip over it. Total these up and we get $1.9 billion. Now, if you add up each of these categories' totals, you get this number down here. This is the change in cash and cash equivalents. The final thing I want to point out is free cash flow. A quick and easy way to calculate free cash flow is to subtract capital expenditures, right here, from cash flow from operations. So in our example, we would subtract the $1.1 billion from the $3.6 billion, and we get $2.5 billion free cash flow for this time period. In 2016, we get $1.95 billion, and in 2015, we get $3.7 billion. To me, this is important when analyzing, in this case, a company like Nike, because you're looking for trends, you're looking for where the company could end up. The theory behind free cash flow is that it accounts for cash actually coming in and subtracts out what it takes to run the business. That's why you take away capital expenditures. This should, in theory, be more dependable than earnings per share or some other metric that is less tangible than cash. Well, that's all we got for the cash flow statement. I hope you found this very useful, and I look forward to seeing you in the next video. Thank you.